The United States Supreme Court just categorically struck down the current administration's global tariff regime. Within 24 hours, the White House retaliated by invoking Section 122 of the Trade Act of 1974, imposing a new 15% global baseline tariff. At the exact same time, NATO allies are actively deploying military personnel to Greenland in direct defiance of United States rhetoric. The global financial markets are entering a highly volatile period, and participants face an unprecedented confluence of macroeconomic disruptions. Welcome to Coffee Break Capital. Financial markets move fast, but we move faster. Sit down, take a sip, and let's get you caught up on the numbers that matter today. We are starting with the bullish side of the market today. While uncertainty dominates the headlines, major capital is aggressively flowing into defensive sectors. First, the defense sector is experiencing a historic surge. Following U.S. rhetoric regarding the sovereign annexation of Greenland, Denmark, actively supported by a coalition of NATO allies including the UK, France, and Germany, launched Operation Arctic Endurance. They are deploying military assets to act as a physical deterrent against the United States. This geopolitical rift has propelled European defense stocks to all-time highs. Companies like Rheinmetall surged 19%, while Saab and BAE Systems are also seeing massive gains as the market prices in a permanent war economy. Safe haven assets are also seeing panicked inflows from institutional investors. Gold bullion spiked 2% in a single day, reaching a 3-week high of $5,209 per ounce. If you want to stay ahead of these massive geopolitical shifts and protect your portfolio, hit that subscribe button right now. We bring you the data that Wall Street reads every single week. Looking ahead to early March, the artificial intelligence infrastructure supercycle remains a massive bullish catalyst. Broadcom is preparing to report earnings, and their total confirmed AI product backlog stands at an unprecedented $73 billion. The market expects Broadcom's first quarter revenue to reach $19.10 billion, representing a 28.1% year-over-year increase. Finally, some major emerging market economies like India, China, and Brazil might realize a net benefit in the immediate term. The new 15% tariff is functionally lower than the punitive double-digit levies these nations previously faced. Now we must pivot to the bearish catalysts that are actively threatening broad equities. The global trade architecture is facing a destabilizing shock. Last Friday, the Supreme Court ruled 6-3 to explicitly remove the International Emergency Economic Powers Act as a legal justification for peacetime import levies. Justice Brett Kavanaugh warned this would create a logistical mess for the Treasury, as importers demand refunds for billions of dollars. Prior to this, the government had collected at least $130 billion under the IEEPA regime, with 90% of the financial burdens absorbed by domestic businesses and consumers. In response to the ruling, a temporary 15% global baseline tariff was announced, with an initial 10% levy officially taking effect today, February 24th. The market reaction was severely negative. The Dow Jones plummeted by nearly 850 points during the immediate trading session. Consumer discretionary stocks face immediate margin destruction, with Nike falling 4.9% and Gap dropping 3.0%. The Russell 2000 index dropped a disproportionate 1.8% because smaller companies lack the supply chain elasticity of their megacap peers. This tariff shock is spilling directly into Federal Reserve policy. Governor Christopher Waller noted that a March rate cut is currently close to a coin flip. If supply chain costs rise rapidly and are passed to consumers, inflation will forcefully re-accelerate, entirely eliminating the Federal Reserve's ability to cut interest rates. Also, in the enterprise cybersecurity market, CrowdStrike faces bearish risks heading into its earnings report, with analysts warning of a potential deceleration in net new annual recurring revenue growth down to 14%. Looking at the road ahead, we have clear predictions for how this highly volatile week will unfold. First, expect intense volatility in the sovereign bond market. President Trump's State of the Union address is scheduled for today. The theme is America at 250, strong, prosperous, and respected. If he aggressively defends his new tariff policies and demands further domestic stimulus, bond vigilantes will price in heavy deficit spending. The 10-year Treasury yield is already trending sharply upward, sitting around 4.043%. Furthermore, interpreting macroeconomic data is notoriously difficult right now, especially with severe downward benchmark revisions, showing only 181,000 jobs added for all of 2025. Second, the consumer discretionary sector faces a critical test. Home Depot reports earnings today, with expectations of $2.53 per share on $38.03 billion in revenue. Lowe's follows closely with its own report on Wednesday. These reports will provide a critical read on housing and durable goods spending. If management signals that consumers are actively deferring non-essential purchases due to renewed tariff-driven inflation, it will cast a dark shadow over the United States GDP growth outlook. Solid guidance from Home Depot and Lowe's is required to prevent a steep sell-off in consumer discretionary exchange-traded funds. To conclude, This trading week presents an incredibly complex and highly asymmetric risk environment for global capital allocators. The foundational global free trade consensus is operating under severe immediate strain. Institutional positioning must heavily prioritize defensive optionality, high free cash flow generation, and the strict avoidance of import-reliant corporate business models. The unprecedented combination of inflationary United States tariff policy and the potential for a paused rate cut cycle suggests the era of aggressive central bank easing is officially pausing. This information was compiled from various sources across the internet and is not intended as financial advice.